Welcome, Coleman Report Live, early December edition. Lance and I were on the plane. We're going to tell you all about Washington, D.C. We had an awesome experience. We're going to answer your questions. But first, we're going to start off today with Michael Schwartz out of Moody Analytics. He develops small business lending and credit decision solutions for financial institutions. What is that all about, Michael?
Thanks, Bob. Thanks for having us. At Moody's, which is a subsidiary of the Moody's Investor Service, we basically focus on analytics, credit risk management tools that we help to drive risk rating, performance, and financial modeling for a number of financial institutions and corporates worldwide. And we're coming to you live from up here in New York City at Moody's headquarters.
Awesome. What's your weather like there?
It's pretty chilly. It's, I think about 30 outside.
Nice.
So
well, as I said, Lance and I were in Washington, D.C., and it was cold for
hey
someone
guys.
from California. Hey, Michael, you and I are going to do a webinar next Tuesday. It's a free webinar, so please go to our website and sign up for it. Tell us a little bit about the webinar, Michael.
So we're running a webinar next week. It's focused on putting the customer first, top technology trends, as you see here, that are going to define small business lending and the success in the future. We've observed that there's a lot of banks out there that are looking to converge some of the consumer lending processes and bring them to small business, how we can fully automate the process. And basically, we're going to walk through 5 trends that we feel are more prominent industry-wide and give you a little bit of feedback beyond. We do have a bank that we've been working with here that's going to join, and one of their credit administration directors is going to offer his perspective as well. And basically figuring out how these digital transformation strategies are driving banks for the digital age.
Michael, I'm a big capital to Main Street guy. How does this help get capital to Main Street?
So everything we're focused on here at Moody's is really finding ways that banks can make better decisions faster. And with the volume that is centered around small and medium-sized enterprise lending, we feel that there's a lot of opportunity to grow there. So basically, a number of the risk management tools, scores, models, and solutions that we've been building are focused more so on the smaller side of the small and medium-sized enterprise subset. So really, we're driving that momentum to try to help bring solutions to lenders nationwide that are focusing on building out their portfolio specific to small business.
Awesome. Hey, I look forward to talking with you next Tuesday, December 11th at 11 a.m. my time at 2 o'clock Eastern. Michael, thank you so much for joining us.
Thanks all.
Poll question. What percentage of SBA 7A loans are sold to the secondary market?
Bob,
And the reason why I asked this question is Lance was one of our instructors at the summit held Tuesday, which was, Lance, we packed the room. We had 70 people. We're going to talk about that. But one of the takeaways, but I think this is an important thing and very good. No, it's not 50%. It's 30%, Lance.
Yeah, Bob, I would have jumped in there, but I had a little advantage having participated in the secondary market summit. And guys, it was a great conference filled with investors, SBA lenders, SBA staff, and a lot of participant bankers. So it was a lot of fun. But Bob, I got the answer from Mr. Wade himself.
That's right. And it's really nice that SBA supports coming to that event. And we'll be reporting about that over the next month. I will not put up the chart that Bob Judge at Government Loan Solutions does with all the crazy things, because I got to be honest with you. He's the only one in the room who understands. Well, there's probably some smarter people than us who understand that. But those are a lot of crazy graphs about it. What's happening in premiums.
Well, the Government Loan Solutions guys, I had a little hors d'oeuvres and a beverage with his partner. They are statisticians, Bob. They know the numbers as well as anybody, and they follow the secondary market on an incredibly detailed level.
Yeah, the secondary market premiums, I finally just asked the question, how much are they down? And he said about 15%. But then he gave a long explanation that supply, demand, we wrote about it yesterday if you really want to dive a little bit deeper into that. And the takeaway I got is while it may be down, that's not a permanent trend. Is that what your sense, Lance?
That is, from all the speakers, Bob, it seemed like that they were going to stabilize some during the coming year. They might tick up a little, but they basically indicated 19, they expected secondary market premiums to stabilize a little more. They've been declining most of the year, Bob.
They've been declining, but I think the takeaway for your budgets for next year is that 15% decline in 2018. I don't think you have to put in another 15% decline in 2019. That was sort of the takeaway I got. I think it's going where we are today is we're going to be for a while.
Your own point, Bob, because again, I walked away thinking, okay, premiums will be smooth and stable.
Yeah, very good. Second poll question. Now, this is interesting because this is something that I asked John Wade about. John Wade is chief of the secondary market for SBA. And I said, do lenders who sell loans to the secondary market, is that a negative impact on their PARRIS score? So I want to ask you is, do you believe that if you sell a loan to the secondary market, when I say raise is bad. So is that a negative mark on your PARRIS score?
Bob, I have an answer. My answer is in line with our participants in that I don't think selling them on the secondary market has a negative impact on the PARRIS score, Bob, but it is a red flag item if you sell over 75% of the loans that you do on the secondary market.
And when you say red flag, and I did not know that, there's actually a little flag in your PARRIS dashboard that there's a red flag, there's a check mark. But you're right. Go ahead, Lance.
There's a number of red flag categories that don't actually impact your PARRIS score. Just another example, Bob, the number of agents that you use. If you use an agent on all of your loans, that is a red flag category as well. Doesn't mean your PARRIS score is going to drop. Doesn't mean it's necessarily a bad thing, but it does mean that SBA will take a look at those items in particular if they do a on-site or off-site review.
Yeah. So that's I'm glad that's something that I learned. Hey, the next day we had a USDA Rural Development Conference that I attended and met all the USDA people. And here's a question for you. SBA loans are what we call a zero subsidy, which means the program pays for itself by all borrower fees and lender servicing fees. What about the USDA program? Are USDA guaranteed loans subsidized by the taxpayer?
And Bob, this is a great question because I don't know the answer. I am going to go with true.
And you are correct. 50-50. Look, the reason why I asked this question, in the Farm Bill, there have been major negotiations on the Hill. Lenders want this program to go to zero subsidy. And the best analysis is when SBA 7A went to zero subsidy, we had a $1 billion program for the USDA B&I and Community Facilities Program, and SBA was about $9 billion. Today, SBA is over, $36 billion, and USDA is still at $1 billion. When SBA went to zero subsidy, it got bipartisan support, specifically Republican support on the Hill, and lenders are pushing Congress to go to zero subsidy. And when you're pushing this to Republican senators, say, hey, we think we're smart enough to be able to manage this program and it can pay for itself, all of a sudden you got everyone on board.
Bob, are we going to talk about the Senate Small Business Committee?
We are, but you have to follow the script.
I'm going to shut up. I had a comment.
But let's go to a question from Paul. We're going to make Paul a contributing editor of this. In fact, you know what? We need to get Paul on. Joseph, make a note. We need to get Paul on to ask questions live. Paul, if you're willing to do that, we'll do that. But here we go. We had a loan sold on the secondary market 4 years ago. We want to buy it back from the investor group because they will not fix the interest rate. Do we have to refund that premium? What is stopping somebody from selling to the secondary market to the premium and buying it back a year later and then reselling it?
Bob, that's a great question because in my presentation to the Secondary Market Summit during the Q&A session, we actually talked about this specifically. And one of the investor groups stepped up and said they planned for that 90-day period, that a certain number of loans could be bought back. They don't, after the 90-day period, and this was the takeaway I got in the Q&A session, they do not expect a refund of the premium after that 90-day mark.
Because they put that in their pricing models, in their calculations. But you're right. If you buy the loan back in 90 days, you have to give back the premium. But after that, you're good. In this situation, Lance, perfectly permissible for the lender to buy it back. Don't have to refund the premium. And then how long does the lender have to hold it before they can resell it? Now, this is an age loan. You're not going to get a lot of premium, but you can resell it. Correct, Lance?
We talked about this also, Bob. It was a great cue. I loved my presentation, not because of the material I presented, but because of the questions and the interaction that occurred afterwards, because we had participant lenders and investors going back and forth on issues. But if you buy a loan back, it's got to have a 12-month period.
12-month. Okay.
Seasoning before you can turn around and sell it again, and that was also talked about during the Q&A session. So, Paul, the initial reply I gave you is kind of enhanced in that, after that 90-day mark, you said this loan was 4 years old. There's not even a prudent reason to give it back.
Hey, I see Andrew's on the line. He was in the secondary market. Here's a picture of Senator Risch, our keynote speaker. We inducted him as an honorary member into the Hall of Fame. We had two other inductees, Chris Laporte of Coastal Securities, and we also had in memoriam. I blanked. Help me out, Joseph. Who was it?
Mr. Mark Atwell.
Mark Atwell. Thank you. I apologize for that. Mark was well loved in the industry, and he passed away unexpectedly last year, and we were honored to induct him. And here is me giving the plaque. Lance, what is this picture about?
Well, the senator was kind enough to invite us to go pay our respects to President Bush. And after that, we were able to spend some time at the Senate Small Business Committee office, and this is the crew in front of the Senate Small Business Committee office. And I want to comment on the senator's presentation, Bob. It was very entertaining, and I walked away knowing that he strongly supports the Small Business Administration loan
He's
program.
the chair of the committee. Again, Republicans, which have historically been reluctant to support this program, but he's a strong supporter. He will be rolling off, and Senator Marco Rubio of Florida will be the new chair next year.
Well, I look forward to that, but we couldn't have had a better supporter in that role. Again, his speech was very entertaining, very informative, and you walked away saying, this guy loves the SBA.
Yeah, and as he said, he loves talking to capitalists.
Yeah.
No, what you get. In this picture, myself, I'll go back to the picture, Joseph. Brent Trulino, that big guy in the middle is Lance, Joseph Coleman there. Joseph cleans up well, and Chris Hearn.
Hey, Brent, it's always good to have Brent around, especially when I'm presenting material, Bob, because he'll always pull me aside and tell me whether he likes it or don't like it. And
as a personal comment, Lance and I were treated to VIP treatment, and they put us to the front of the line. We had people were waiting 5 hours. We had like a 4-minute wait.
Hey guys, we got to go through the tunnel. That was fun.
Yeah. But it was a great experience to be able to pay our respects to President Bush. That was very moving, and it was very gracious of Senator Risch's staff to set that up for us. Let's move on. Here we go. These are some of the stats. I published these yesterday. 33% of loans are sold to the secondary market. 90% of those are pooled. And then if you like the stats, $10 billion last year was sold to the secondary market and pooled. And this, I don't know, I think I know who set this up back in the 80s, but to allow lenders to sell these loans with the full faith and credit of the U.S. government behind them is so dramatic, and that doesn't cost anything to the government, doesn't cost anything to you and I as taxpayers, and it allows us to get capital to Main Street. And I cannot underestimate the importance of allowing lenders to do this and sell them at Treasury bond grade.
Bob, one of the things that I took away too in discussion, I was never aware that 90% of all the loans sold on the secondary market are in pools.
And explain what that means. There's someone out there who doesn't know what.
Well, they just take a group of SBA loans and put them together and sell them to investors. And where that becomes significant is my presentation. Are we going to talk about that, or should I stop?
No, I want you to talk about that. We're supposed to have a slide of your presentation. Let's go ahead and talk about it now. Talk about it now.
My presentation was on servicing and liquidating and developing workout plans on loans that are sold in the secondary market. And I had always believed, Bob, that when we send servicing actions into the investors and they get declined almost 95% of the time, and one investor chimed in, he said, that's because they're in pools. He said, when you sell a loan, one loan to one investor, that servicing actions are all, he indicated in their case, it was a group from Oppenheimer, that if they had bought an individual loan that was sold in the secondary market, that they would almost always consider servicing actions. So I'd always thought, to some extent, Bob, that the investors were just being hard-headed and wouldn't participate in servicing. But the big challenge is so many of those loans are pooled, and that's why we quite often get a negative response on a servicing request.
And here we go. Here's our chart from our quant, and we'll have a test on this. Don't worry about it. I just want you to, this is some of the stuff you missed. And he explained the chart. Actually, I know how to read this. But that's what you missed. We can move on. Go ahead, Lance.
Hey, Bob, one of the really incredibly interesting presentations, a guy from Live Oak Bank was presenting on a concept of how to pull fixed rate loans and get premiums similar to variable rate loans. The end result is they went through a lot of analysis and couldn't figure it out. But I think it's a very interesting concept, Bob. If somebody could figure that out, you might see more fixed rate pricing on SBA deals.
Yeah, and that's and a takeaway on that was, I cannot tell you what premium you're going to get, but I can tell you it is a viable product. You can sell it to the secondary market. Obviously, the premiums will decrease, but you will get a premium.
Yeah, absolutely.
And go ahead, Lance. What happens if the investor declines the servicing request? I believe this is from your presentation.
Well, if you send a servicing request into an investor and they say no, and it's important to the viability of the small business, then you can request a emergency repurchase by SBA. And effectively what happens is SBA will buy it back from the investors, and then instead of making a request to the investors and then to SBA, you're going to go directly to SBA for a servicing request. But if you've got a loan sold on the secondary market and a servicing action is necessary to keep the business viable, you can request an emergency repurchase from.
And this is what you need to do. Here are the 4 steps, Lance. Discuss them.
Well, I mean, you're going to collect information. You've got to have current financials. That's always important in normal servicing. A decline letter, email from the investor, a statement of how the proposed change is for the benefit of the borrower and how it will allow them to remain viable, and then a certification that if SBA approves the request, that the bank will in fact implement that servicing action.
And finally, we reported on Monday, and this is, again, we're now in the 8th, 9th year of this strong cycle of recovery to Main Street. And here it is. PayNet, who Bill Phelan, who is a fan, or I'm a fan of what they do, and they track small business lending to Main Street. They also track defaults and delinquencies by geography as well as by industry. And they're saying, hey, we're still continuing pumping out money to Main Street. But Lance, Joseph, go back to that chart. I will give you one takeaway. The one scary takeaway from this chart is it's 2005 all over again. The numbers look just like 2005, which was 2 years before the recession. No one in the room, and Lance and I are certainly not predicting another recession, to the extent of what we experienced in 2007, 2008. But the numbers are trending that we are going to be entering into a recessionary period, and two things will happen. Credit to Main Street will constrict, and more importantly, delinquencies will rise. And there was a lot of discussion with 4 more interest rate bumps planned for next year. That's going to crunch Main Street balance sheets.
Bob, I read and I'll do this quickly. I read an interesting article on the plane ride home, and it's about some of these online lenders and a little trick that they're using to kill small businesses. In their paperwork, they have a consent of default.
Right.
And the state of New York is incredibly amenable to allowing that as part of the getting a judgment on the small business. And it was just saying, if you're a small business and you're borrowing from one of these groups,
they can
make sure
tap
you do
your checking account for the full amount.
So, Bob, real quickly, where this comes in to an SBA participant lender, let's say you're looking at refinancing some of that high interest rate debt. You want to see all the paperwork, because of that consent to default is in that documentation and they signed it. You know, they may tank before you ever get them to the closing.
Well, the difference between 2005 and 2018, 2005, we didn't have these online lenders. Yeah. You can go today. I'm a small business owner. I can go today and I can go to my PayPal account and I can get a check I can get money tomorrow. And every small business can do that. And the problem is for you is that you may have a borrower who's in trouble and they go to these online lenders and they're simply delaying the death of that business by 6 to 12 months. But more importantly, a potential recovery to you is going to be lessened dramatically.
Well, and people say, why does New York make the difference? Well, they can process, or they can move to a judgment on a loan made anywhere in America in the state of New York.
The takeaway is, in your underwriting, I would ratchet it up a notch. Just make sure the cash flow's there. Make sure you understand secondary sources of repayment, and make sure that business can absorb another 1% increase in interest rates. John Wade predicted 4 more bumps in prime next year? 3 or 4. I need to be specific. Yeah.
Yeah, I hope not. The other thing, Bob, is on a refinance, normally you just have to get a copy of the note and the payment history. I'm suggesting if you're refinancing these high interest rate online lender type products, you need to see all the paperwork, not just the note.
Yeah, and understand that. And you need to have a heart to heart with your borrower and say, you cannot go back and do that because it will be available. So just all we're saying is the good times will not continue. That's all that we're saying. Hey, Lance, give a pitch for your webinar next week. What are you going to talk about?
Well, I'm going to provide a webinar on franchise lending, and we're going to talk about necessary documentation for the franchise loan, but we're also going to talk about some just good underwriting standards that apply to franchise lending, like documentation of equity injection and also making sure you meet the credit elsewhere standard.
And credit elsewhere that came up in the secondary market. And Lance, I don't think you were there on Wednesday, but that also came up on rural development. They made a very strong pitch and say, hey, we are going to be enforcing credit elsewhere for these USDA, BNI, and community facility loans. Hey, that's all the time we have. Thank you all for joining us. We'll talk about more next week. Thank you.
Thank you. Have a good weekend.